Silver was up 2.4% on the week, still down 20% on the year. Gold is barely down on the year. It's down about 7% on the year. But considering the huge gain that both metals had in 2025, it's not that big a decline, but it's enough to create a buying opportunity. And in fact, a lot of people got scared that the war was going to be bearish for gold, that rising interest rates were going to be bearish for gold, and they are wrong. They're actually bullish for gold. And this week may be an indication that investors are figuring that out.
The global financial landscape is confronting severe disruption as expanding geopolitical turmoil and surging energy costs destabilize traditional market expectations. Mainstream investors frequently misjudge how gold and silver behave during periods of elevated inflation and international conflict. Peter Schiff, a well-known economist, financial commentator, and author, emphasizes that rising interest rates and war are fundamentally bullish for precious metals, rather than bearish. While Bloomberg quotes one analyst observing that gold is showing a relatively muted reaction to the spike in oil prices, which to me reflects some investor apathy around geopolitics, the core economic indicators tell a vastly different story. Although silver rose 2.4% on the week and gold mining stocks surged, speculative risk assets continue to falter. The clear economic prediction from the transcript is that the recent divergence between oil and gold will dissipate, and both commodities will inevitably move upward together in tandem. As geopolitical apathy evaporates, precious metals are set for a major breakout. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold and silver, precious metals, had a good week. Gold was up about 1%, nothing spectacular. But gold rose 1%, even though bond yields rose significantly. And even though oil prices rose significantly. Now, you might say, rising oil prices, should be good for gold because gold and oil should be correlated, but they haven't been correlated recently. Ever since the war broke out, the Iran war, there's been a divergence. It's been opposite. Gold and oil have gone in the opposite directions. And I've been saying that eventually that's going to change and oil and gold are going to move in the same direction. And that might be happening. Now, we didn't have a big move in gold this week. We did have a big move in oil, but gold didn't go down. And the fact that it didn't go down and in fact managed to rise, I think shows that that is happening. And that is very significant for precious metals investors. And look what happened. Silver was up 2.4% on the week, still down 20% on the year. Gold is barely down on the year. No, excuse me. It's down about 7% on the year. But considering the huge gain that both metals had in 2025, it's not that big a decline, but it's enough to create a buying opportunity. And in fact, a lot of people got scared that the war was going to be bearish for gold, that rising interest rates were going to be bearish for gold, and they are wrong. They're actually bullish for gold. And this week may be an indication that investors are figuring that out. In fact, if you look at what happened to the mining stocks, GDX was up 5.6% on the week, and GDXJ up 5.8%. These are decent moves where gold was only up 1%. A lot of leverage this week in the miners relative to the metal. I think that's a good sign of a bottom, that we're moving a lot higher. These stocks are still great buys. They're down on the year. The GDX is down 12.25% so far this year, and the GDXJ is down 14%. And another week where Bitcoin didn't really go anywhere. I mean, I know the week is not quite over yet because we still have the whole weekend, but I think as of when the markets closed on Friday, Bitcoin was down close to 1% on the week. I think it ended last week close to 65,000 or just below, and this week it barely managed to gain or close above 64,000. In fact, as I'm recording this on Saturday afternoon, Bitcoin is about 64,300 and change. So it's gained a little bit since the close in New York, but still an uneventful week for Bitcoin. Didn't move up with the precious metals, went down with the risk assets. Year to date, Bitcoin was down about 29% as of the close on Friday, and about the same today still. That's a big drop, 29%. MicroStrategy, even worse, down 4.5%, strategy. Again, they should have just called it micro based on where the stock is going rather than strategy because they have none. But down 4.5% on the week, now down 42% year to date. Stretch managed a slight gain on the week of 0.4, but still down 13% on the year. The price is 86.88, meaning the current yield, because the coupon is 12%, the current yield is just under 14%, 13.8%. Investors don't believe in Bitcoin anymore, at least institutions. Apparently, according to Saylor, institution stepped up and bought some Stretch over the last week or two as retail sold. Obviously, retail sold for a loss, but this is still overwhelmingly a retail product. But I don't read anything bullish into this. The fact that institutions put their toe in the water, maybe that's a short-term trade, or maybe they're making some bearish bets where this is a hedge. Maybe they're shorting strategy and buying Stretch, or shorting Bitcoin and buying Stretch to get that yield and have a hedge. These are bearish bets if in fact they're being made. And I think Wall Street's rhetoric doesn't match their action. They're still trying to get customers into Bitcoin, but they have no interest in it themselves.
For over a decade, the Federal Reserve maintained artificially suppressed interest rates, enticing individuals and governments into massive debt to finance non-productive consumption. Steve Hanke noted these escalating market consequences, tweeting, "The 2-year U.S. Treasury yield has risen to 4.2%. That's well above the Fed's Fed funds target range of 3.5 to 3.75%. The bond vigilantes have come out of hibernation. The inflation genie is out of the bottle. Rising yields are punishing speculative assets." With Bitcoin tumbling 29% year to date and related equities dropping sharply. The definitive economic prediction is that the United States is rapidly advancing toward an unavoidable fiscal crisis. Mounting budget deficits will inevitably force monetary authorities to print massive amounts of currency to service the debt, accelerating dollar debasement while worsening long-term domestic inflation. Now, let's get back to the interview.
The Fed kept interest rates so low for so long, specifically so people would go out and borrow money. And I remember all these so-called experts talking about how everybody should take advantage of the cheap money, that the government should take advantage and borrow all this cheap money while they can, that individuals should borrow and corporations should borrow all this cheap money. And I kept pointing out that that was flawed logic. And an analogy I used was, well, what if heroin was free? What if somebody was giving out free heroin? Should you just go out and buy it and use it because, hey, it's free? I can't turn down free heroin, right? It doesn't cost me anything. I might as well just buy it because it's so cheap. Well, no, because it's harmful. Just because something is low cost, if it's bad, you don't do it anyway because you're getting a good deal on it. Now, yes, if you could have borrowed that cheap money and put it to a productive use, if you could use it to make a capital investment that would generate a yield that could be used not only to service the debt, make your interest payments, but retire the principal. Yes, it lowered the hurdle rate, making investments that might otherwise not be financeable. So to that extent, sure. And that may have been a mistake economically. The Fed may have been encouraging investments that shouldn't have been made because interest rates were artificially low. Maybe if interest rates were allowed to reflect the actual time preferences for money, some investments wouldn't be financed because they're not really viable given the amount of savings in the economy to support it. The Fed sends false messages to the markets with artificial interest rates, which is, where you get these booms and busts. But at least that was viable on paper. But a lot of the consumption, or a lot of the loans rather, that were taken out because of the low interest rates went to finance consumption, especially the government. All that money was consumption. All the money the government borrowed was to make Social Security payments, Medicare payments, fight wars, pay pensions, all these programs that the government funded with that money, all the bailouts and all the stimulus after COVID. We borrowed all that money. Now the money is gone. There is no asset to retire the debt. There's just the American taxpayer who has to work harder or pay higher taxes, or we need the Fed to print more money, and create more inflation. But the point I'm making is these interest rates are a much bigger problem now. But the bigger problem is they're going to keep rising because the U.S. is headed for a fiscal crisis. Our deficits are running out of control. The market is losing an appetite to finance, to the willingness to finance the debt. That's why they're demanding higher interest rates. But higher interest rates weaken the economy. Higher interest rates cause our budget deficits to rise because it means the government has to spend more money it doesn't have to pay interest on the debt. So as interest rates rise, that causes a higher deficit, which causes interest rates to rise more because the bigger the deficit is, the more investors are worried that the Fed is going to have to create inflation to service it, which means you don't want to own the debt because it's going to be debased. So we get in this vicious circle where monetary policy interest rate cuts are no longer effective fiscally because of the immediate impact that higher interest rates have on the fiscal situation of the United States. Now, so far, the dollar has held up. In fact, the dollar index was up a little bit on the week, so it didn't go in the same direction of gold. But I think ultimately the dollar is going to decouple again in the same direction, and we're going to start to see the dollar falling when interest rates rise. Right now, the dollar gains strength from these higher rates because supposedly it's indicative of the fact that the Fed is, going to hike rates, or it's supposedly going to be good for the dollar. But I look at rising interest rates as a repudiation of the dollar, of lack of willingness to loan dollars to the United States at rates that we can afford to pay. It's part of the de-dollarization trade. And ultimately, the dollar should decouple and start to fall as bond prices rise. And when that happens, that is going to accelerate the crisis.
Keynesian macroeconomic theory relies on the flawed premise that government interventions can successfully manage economic outcomes, yet central planning repeatedly exacerbates systemic financial fragility. Establishment economists often advance misguided arguments to explain away the performance of precious metals during volatile cycles. Addressing these mounting pressures, Schiff Gold highlighted, Fed Vice Chair Philip Jefferson says oil shocks, AI investment, and persistent inflation are making monetary policy a delicate balancing act. As uncertainty grows, gold continues climbing above $4,000. Standard claims that gold underperforms during wartime or amidst rising treasury yields remain completely specious. Although the US dollar index temporarily held its ground, underlying monetary dynamics are shifting rapidly. The explicit economic prediction is that the US dollar will ultimately decouple and fall sharply as rising interest rates reflect a widespread global reluctance to lend to the United States at unaffordable rates. Once this currency decoupling occurs, it will dramatically accelerate the approaching fiscal crisis, demonstrating why investors must focus on physical gold and silver to protect their capital against inescapable monetary debasement. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.